Hello and welcome to this edition of Closing Trades right here on ET Now. And we're holding out quite okay. Once again, we're making that dash towards that 26,000 mark for the Nifty. But I think more than the Nifty, it's what's happening within the broader end of the market. While the Nifty started off quiet from the word go pretty much, it was the market breadth which was favoring the advances by a huge margin. And that story clearly continues right now as well. So look at the individual movers. Look at what's happening with the Sammaan Capital. That stock holding higher in excess of 4.5% right now. Angel One higher by over 4% as we speak. Siemens, like Harsh was just flagging off, reaction to its earnings, 3.6% higher there. And Nykaa, which is also holding up a solid 3.5% as we speak, 269 is where that counter is. So good going within the broader pool of the market. And I think that is a better convincing sign. But let's get some convincing there. Kunal Bothra joins in at the studios as always. Kunal, hi, afternoon. What is it that you're making of the strength in the broader market today? Because that is what stands out as opposed to the Nifty.
Yeah, and I think that's the hallmark of this rally which you're seeing today, where you're seeing the mid-cap index, small cap indices a little bit more stronger than what they were in the previous versions when the markets was hitting where the indices were hitting the 26,000 mark. So that's a very good refreshing change for the overall market, because now is where the sentiment starts to become a lot more positive when you see the mid caps and small caps participating. Earlier it was a lot more concentrated, where you had only very few select sectors or large cap names which are participating. Now that breadth has started to open up, and I also believe that we are seeing fresh sector participation which has happened today. For example, the auto stocks have made a very good comeback, and it looks like that many of these auto stocks are now coming back after they are maybe few weeks or a couple of months of consolidation. After that steady uptrend, these stocks and sectors had seen from August and September. So I think in that sense, we could be looking at a fresh churn which could happen. And there are also other sectors which are trying to make a comeback. PSU banking stocks made a very strong comeback. You saw many of the PSU banking names hitting fresh 52-week highs. So I think on the back of this, I would probably expect the markets to regain momentum, and hopefully this time around we may just sustain about this 26,000 mark and fall and not reverse or fall very quickly.
Okay, what do you make of the Nifty banks move, Kunal? Because that's the other very interesting one.
Yeah, it's a very strong and a powerful move. So it started off with PSU banking names first, showing signs of a breakout, and then you saw short covering across many of the large cap private sector banking names. Axis Bank, for example, has been looking quite charged up. HDFC Bank in the last half an hour, last 1 hour, I think has picked up good pace, trying to inch back closer to that 1,000-odd mark. So there are few larger cap heavyweight names on the private banking side which are making a comeback, and again a very strong move for the overall bank Nifty. In fact, the last 6 or 7 days, there was almost like a 12 to 15% reduction of open interest for the bank Nifty in a very gradual kind of a manner. And this goes to show that short positions or traders who are on the short side start to unwind their positions on the bank Nifty. And now we are looking at a breakout of sorts for the banking index. I would probably place the next set of targets for the banking index at least another 1,000 points higher from current levels, which means we should be looking at a target closer to 60,000 odd for the bank Nifty.
Kunal, let's talk about some of these mid caps. And I can see once again, those internet plays, capital market theme, that's really coming back. So while, of course, there is a Sammaan Capital, there's Angel One, which is holding out, there's Nykaa, Policy Bazaar, all these names as well flying up. And, of course, Paytm as well along with that. But let's first talk about the top two movers today. Angel One, Sammaan Capital. What do you read on the charts?
So Sammaan Capital is a very interesting chart. After the change of name for the stock price from Indiabulls Housing, I think we've seen a very different kind of a move for Sammaan Capital. There was a major price up move, I think closer to 160 odd mark for the stock price a couple of months back, and from there on we've seen the stock moving up higher. The recent high for Sammaan Capital was around the 192-94 mark, and from there the stock again reversed or retraced 10%. So which means it's going through as a classical uptrend, a breakout on the back of very high volumes, a further continuation up move, then a mild reversal or a mean retracement, and now the stock at 180 levels thereabout, I think looks to be attractive yet again. So the risk reward is favorable, volumes are strong, the trend is quite positive. I would look at a retest of the previous highs at least for Sammaan Capital, which means closer to 194 to 196 could be a near-term target range. Angel One could be a different ball game altogether, because the stock is coming out of a massive breakout zone. So earlier in the last many months, the stock was going through a huge round of volatility, and that volatility was almost like a 20% swing for the stock price in a matter of 1 to 2 months. That I think pattern could change now for Angel One. You've seen consistent approve building into the stock price. The last 1 week, 10 days also, the stock has moved up 200 odd points, including today's move. So that itself indicates that we are looking at a big change of trend for Angel One, and that high round of volatility is now behind, and we could be looking at a further up move. So near-term targets for Angel One would be closer to 3,000 to 3,200.
Wow, some considerable upside that Kunal you're seeing on a couple of those counters. But give us your other stocks which are on your radar. What are your picks?
So the first one, which I would suggest at current levels, is again a breakout candidate on the short-term charts, and that's Maruti. Been bullish on the stock in the last couple of months, and I think at current levels of 15,750, 800 thereabouts, it looks attractive for a further up move and potentially a retest of the previous highs of 16,500. Stop loss for this trade could be kept at 15,500 mark. And the second would be a buy on BHEL. Again, a fantastic chart on the short to medium term basis. The stock went through a breakout closer to 290 plus levels, retraced back again. So the risk reward is attractive at current levels. Would look out for targets in the range of 300. Stop loss at 278.
Okay, let's take a very quick break on that note. When we come back, of course, we'll continue tracking markets. But here's the SEBI chairperson himself, Tuhin Kanta Pandey, on the sidelines of the CI event here in Mumbai, saying that investors' trust in India is the biggest shield that they have against global shockwaves.
Individuals itself, they hold, more than 17-18% of the listed markets. We do have DIIs and individuals put together. Now, FPIs are actually under 17% today. So one is that this process, which is the more, 135 million investors, unique investors, that institutional investors, the mutual fund industry, this is the industry which believes in India's story, because India's story is not really built on any bubble. You have a very strong economic growth which is happening. And there is a demographic dividend, there is a talent pool. There will always be risks, and there have always been risks to external risks. Whether it is trade related or whether coming out of the stock markets or the financial markets. But I think whether it is RBI or SEBI, we have been working together always, and we have a fair amount of models on interconnectedness and how it happens when you have redemptions, what happens when there is so mutual funds have to do, for example, stress testing, and have to publish those results on public basis as per our guidelines. So these are the things that we have built up over time.
Welcome back. You're watching Closing Trades here on ET Now. We're doing well on the Nifty. 26K breached. We're holding up at the 26K level, at least at this point. Nifty Auto is the other one which is doing fairly well for itself, 0.9% higher. Mind you, Autos had a couple of very good days, and Hero is the one which really stands out, 4% higher on a day like this. And this is again on the back of the gains that it clocked on Friday. Very strong commentary coming through on Friday as well from management. In fact, management commentary seemed to suggest that double-digit growth could well be likely for the two-wheeler industry for the next 2 years, given the GST rate cuts. They've not upped their guidance for FY26, but they've said that the festive season sales, or rather from the start of the festive season till now, which is from the start of September till now, despite that lean period till 22nd September, still stands at 17% YOY. So that's very, very strong growth that they've seen. The stock obviously up 8% over the last couple of days. Kunal, what's your view with regard to a Hero at this point?
I think it's an excellent chart, shaping up, because the stock has not just broken past about 5,700 levels, but I think it's managed to break past about the previous highs, where the stock I think had corrected, post the monthly numbers. I think from there, the stock had corrected to almost 300 to 400 points at one point of time. So for the stock to try and make a comeback in just a matter of a week or so, I think indicates that we are looking at a very strong breakout for Hero MotoCorp. So it's an excellent chart. Near-term wise, I would look at the stock continue to moving up higher, and positionally, I would look at 6,000 to 6,300 as a target range for Hero MotoCorp.
Right. Okay. In the meantime, there's an interesting note this morning, and Morgan Stanley came out with a note stating their insight into India's economic outlook for 2026, and they expect to remain upbeat. In fact, Mitali is here from our research desk with details from that note.
Right, so Morgan Stanley has released its 2026 Indian Economic Outlook report projecting a continued Goldilocks environment for the country, powered by strong growth, stable inflation, and improving macro fundamentals. Now, according to the report, the GDP is expected to hold steady at 6.5%, powered primarily by resilience seen in the domestic demand. Also, the report states that the inflation is projected to remain close to the RBI's 4% target through FY27 and FY28, creating room for monetary policy easing. In fact, Morgan Stanley also anticipates a 25 basis point rate cut by RBI in December 2025. Talking about the consumption front, urban demand is showing clear signs of rebound as there was seen a 25% jump in festive season auto sales. Rural demand also remains firm, supported by record agricultural output and rising real wages. The report notes that nominal GDP is set to recover to 10.6% in FY27. In external trade, electronics exports have surged 43%, boosting overall goods exports momentum. However, the United States 50% tariff is expected to affect more than 55% of India's exports to America. Despite this, the service exports continue to perform strongly, with India's global market share now rising to 5.1%. Morgan Stanley expects the current account deficit to remain contained below 1% of GDP, while on the fiscal front, the government has reaffirmed its commitment to discipline, aiming to bring down the public debt around 50% of GDP by the year 2031. Overall, the 2026 outlook signals steady growth, manageable inflation, and a strengthening investment cycle, positioning India for continued economic resilience.
All right. Thank you so much for that, Mitali. And opportune time to take this discussion more towards the fundamental side and more maybe top down. We have with us Deepak Shenoy, CEO at Capital Mind Mutual Fund, to talk to us about exactly that. Good afternoon, Deepak. Let me first start off by trying to get a sense from you. We've closed Q2 in terms of earnings. Talk to us about where are you in terms of what basket do you believe or you're most optimistic about at the end of these Q2 earnings? What's looking the best given the commentary and given where we are at, where valuations are concerned?
So I think two aspects here. The results were kind of decent compared to what we thought it would be, very muted, because most of the impact of the tariffs and all that stuff would have hit us, at least in this quarter. And the GST cuts did not really meaningfully impact the quarter's results. So I think in that context, Nifty's earnings growth of mild, early double digit or big, large single digit. Small cap and mid cap profits have grown more than 10-11%, which in a phase where inflation is very low means substantial real growth. A 14% earnings growth is different at a 9% inflation or a 7% inflation versus at a 2% inflation rate. So you're actually getting a fairly good earnings bump now, despite low inflation. And also, what's happening is that there's early signs of capex revival at the corporate sector. There is some signs of a retail slowdown, which I think will change with the GST cuts. Perhaps the October sentiment was quite good, at least from what we saw in auto and what we saw in some of the financial services, smaller players in the smaller financial services pack. I think we're seeing a fairly good move over there. A lot of the underpriced, relatively cheaper, smaller banks have started to react positively. Mostly those that are following a digital-led strategy going forward. And I think there's a lot of movement on that front. The second area that's actually quite so auto is one, of course. Auto, I think, is a direct beneficiary. But we're seeing some important movements in healthcare as well, where there's some kind of consolidation and growth seems to be more evident in that, even on the results. And of course, engineering, I think engineering is a more longer story. So we're talking of manufacturing in the high-end engineering space. I think that should do fairly well, and some of the capex companies as well. So I would say these are the areas I think will do well in the next few years. But the bigger thing will be to see whether the trajectory is continued in the October to December quarter. So far, the numbers look quite good. Inflation looks low. We are poised, hopefully, for a rate cut at some point because inflation is so much lower than the current interest rate that it's not feasible. India is a capital deficient country, and we can't keep starving ourselves of capital by keeping interest rates this high when inflation is so low. So I think hopefully with a rate cut we'll get some stimulus as well. And if there's even some sort of a US trade deal, I don't think the tariffs are going to go off. I think we just have to learn to live with them and export less goods to the US and focus more on building for India.
Interesting. But Deepak, do you believe while these structural stories may remain in the very interim, this is becoming more like a trader's market? I know Kunal would be very happy here. And within sectors as well, it's the bottom-up plays which are sort of finding favor.
Yeah, it is actually, Aisha. You're seeing the a number of results. In fact, in some companies where the valuations have been high, even good results have meant a stock is broken down. In other companies where the results are ordinary and the stock has already been beaten up, you're seeing stocks moving up. So I think there's a bit of a mean reversion play of some sort. But the trending plays have just started. I think we're just seeing some strong trends emerge. Like I was saying, even in prices, we're seeing these healthcare names, some of the smaller banks, auto, all of them showing very strong, sustained trends for the last 2 months. We've not seen sustained trends for a year. Anything that beyond a month and a half tends to break down. So I'm hoping that this kind of continues, and therefore we get from a trader's market to an owner's market as well. But I think all markets are traders' markets. Some markets are, everyone's markets where everybody seems to make money. We haven't gotten there yet. I think the transition to there is in the process of happening. And I think hopefully we will get a strong up move once the economic recovery kind of starts to show more meaningfully in, across the sectors that we're talking about.
Important news coming in from Bangladesh, though. The Bangladesh Tribunal Court has actually convicted former Prime Minister Sheikh Hasina with a death penalty. Remember, she was charged for crimes against humanity. Bangladesh has been on the edge, so to speak, ahead of this very critical judgment. And, it's finally concluding now after a month-long, or rather months-long trial over her role the deadly crackdown on student protests in 2024. She was then, of course, in exile in India since August 2024, had denied all charges, calling the tribunal a kangaroo court, and insisted that the case was very politically motivated. But that's the verdict which has been handed out so far, that it's a death penalty for the ex-Bangladesh Prime Minister. We'll take a very quick break then on that note. When we come back, of course, we'll continue our discussion with Kunal Bothra and Deepak Shenoy.
Welcome back. You're watching Closing Trades here on ET Now, and we're live from the SBI Live Studio and in conversation with Kunal Bothra and Deepak Shenoy. Now, let me come to you, Kunal. One of the larger banks have decided to go in and consider a stock split, which is Kotak Mahindra Bank. That stock split expected to be announced on the 21st of November. We'll have to see how that plays out. But the stock is up 1% or so in trade. There's been plenty of movement on the stock price, as you can see, viewers. Kunal, what next for this one? Because we've seen a bit of a cool off from the highs. It's refusing to breach certain levels. Give us a sense of where's the support, where's the resistance, what should one expect on a Kotak?
Yeah, so 2050 broadly is a good short-term support for the stock.
Yeah.
Even in this last 4 weeks of a sell-off prior, the stock had not broken below this level. And if we go maybe some time back, then I think this was acting as a major gap resistance for Kotak Bank in the previous leg when the stock had seen a sharp sell-off. I think that was in the month of March, April, May somewhere, where the stock had seen a sharp sell-off and close below the 2050 odd mark. So that remains to be a crucial support for the stock. Even on the shorter term charts, as we look at the stock price, it's nearing a trendline support again at closer to 2050 21. It could be a hurdle point. So in this kind of a setup and a scenario, we ideally look out for short term trades. 2050 could be kept as a stop loss for investors looking at a buy, but then 2200, 2250 would broadly remain as a major target for the stock.
Okay, that's that on Kotak Mahindra Bank. And Deepak, where is it that you stand on the entire BFSI space and especially banks? Because that's where you see the maximum churn happen. Suddenly it was PSBs for a fortnight, and then you have the private banks once again taking center stage.
Yes, I think the early stages of this, Aisha, is that there is a lot of hopes on credit growth resurfacing. We're seeing some early signs of it, but it's still at 10 odd percent, and it's not meaningfully more gone about 12. For an economy to grow, eventually the overall credit growth has to be at the same levels as we expect the economy to grow at a nominal basis. Nominal, we've moved at about 9.9, less than 9%. So credit growth has been kind of relatively slow. So we're seeing the early signs of some kind of a revival, but it's not yet meaningful. And it will, when it starts to grow really strongly, the big private banks will start making a significant dent. But I think we have seen a valuation change in public sector banks. They were valued at substantially lower. Now with the integration of a lot of banks coming together, a lot of digitalization in that sense of a lot of their activities. Some of the public sector banks have benefited and gotten a better price to book than they earlier used to get. Also, the mergers have kind of played their time out, so they've been able to iron out the NPAs meaningfully. With the small private sector banks, some of the players have actually taken to digital much better. We've seen some interest now from foreign banks in acquiring large stakes in certain Indian banks. So I think that has also played a role in giving them a higher price to book ratio than earlier expected. The NBFCs, I think the larger NBFCs will probably still do better. The smaller ones are still struggling for a decent asset liability mix and the net margins, because we're seeing anything below AAA or AA plus, the financing rates become substantially higher. The spreads have increased or widened as your credit quality worsens. And so therefore, I think some of the smaller NBFCs will struggle in this environment, especially when interest rates are falling, to be able to A, raise capital at lower levels, and B, to be able to lend at the rates that they want to make their spreads. So they're trying to lend at 13 to 18%. When in a falling rate environment and aggressive public sector bank positioning, you're going to get a little beaten down in that respect. So I think some of the larger NBFCs will do well. The smaller ones will struggle through this environment until they get their asset liability mix better. So the bets would still be small private sector banks, larger private sector banks later, and then large NBFCs.
Okay, so very, very clear with regard to the way in which one looks at the lending space. But Nifty's Q2 season, it delivered a steady top-line growth, 8% odd, and even with a sixth consecutive quarter of single-digit profit gains. Among major sectors, consumption saw healthy 19% odd growth in terms of top line, while there was some margin pressure for most of them. Ashesha, in fact, joins us with a roundup of all of that. What did we see in Q2, Ashesha? Give us the summary.
Well, yes, interesting analysis done by ET Now's research team, and this is proprietary data that has come in from ET Now's research desk and from the Nifty 50 pack. Let's pull that up for you on your screens. And the kind of revenue growth Nifty 50 companies have reported on an aggregate basis. So revenue growth of 8%, EBITDA jump up of 5% YOY, and PAT also saw an uptick in excess of 5% on a year-on-year basis. So that's as far as Nifty Nifty 50 earnings snapshot is concerned. Banking sector, meanwhile, also reported strong growth. Net interest income growth of 7%, PPOP uptick of 3.5%, and PAT uptick of about 5.3% on a sequential basis. Meanwhile, consumption sector did very well. Revenue growth of 19%, EBITDA and PAT growth in the range of 3.5 to 7.5%. Let's also talk about the IT sector then. Over here, we entered the earnings season with muted expectations. Revenue has risen by 5% YOY. PAT, meanwhile, has seen a decline of about 5% on a year-on-year basis. Let's also put the spotlight on the factors that played a crucial role and what the outlook is from the management going forward. First up, IT, where favorable currency tailwinds aided margins in the quarter gone by. Demand, however, continues to remain steady, but managements believe deal ramp-ups continue to remain steady and perhaps the outlook is improving going forward. Tier 2 players, meanwhile, outperformed large-cap IT companies, so that was the key takeaway that came in from the IT sector this time. As far as banking sector concerned, margins were stable. We did not see any meaningful compression in margins for banking sector. Margins are likely to improve in the second half of this year, and asset quality also continues to remain steady. Shifting focus to the NBFC sector then, over here, second half of the year is likely to be much better as compared to first half. MSME and MFI stress pockets are easing, so this is also likely to aid earnings momentum going forward, and margins were also broadly in line with what the street was working with. Lastly, let's talk about the IT and the consumption sector. Consumption sector, remember Britannia, ITC and Dabur reported strong set of margins in the quarter gone by. Staples delivered solid performance. Volumes, however, were hit by GST 2.0, but remember this was temporary, and GST-led rate cut is likely to aid margins and revenue growth for the company going forward. So yes, on an average, if we look at the performance, that was very strong. We had muted expectations, but earnings turned out to be better than what the street was working with. But most importantly, management outlook going forward continues to remain very positive.
Management outlook remains positive. Thank you, Ashesha, for that. But, you know, top news at this hour from global politics. Ex-Bangladesh PM Hasina sentenced to death. Pooja Mehta joins us from Kolkata on the matter. Pooja, what inputs do you have on this? What are you hearing?
Well, the Bangladesh International Crimes Tribunal has sentenced to death former Prime Minister of Bangladesh, Sheikh Hasina. Remember, she was accused in violation against humanity in connection with the July uprising, and the ICT was hearing. And after the proceedings today, the judge, in fact, has now pronounced her to death sentence, and also her Home Minister Asaduzzaman is also convicted against, in the July uprising case. But what is very interesting is that all these were against the Prime Minister Sheikh Hasina as a part of the July uprising, where several students were killed in the shoot at sight order and also shootings. The court, in fact, said that there were 5 charges under which the Prime Minister Sheikh Hasina was booked, and thereafter, after long proceedings and after hearings at the ICT, the judge, in fact, has now sentenced her to death. Now, we'll have to see what the ICT rules say, whether she has to return to the country and face the sentence, or she can continue to be at large as she continues to be at this point in time.
Okay, thanks much for that very quick update on what we're picking up in terms of news flow from Bangladesh right now, wherein the ex-Prime Minister, that's Sheikh Hasina, has been sentenced to death by the courts there. In the meantime, just taking stock and, getting back to the market action as we speak right now, while definitely we've lifted off from the very somber start that we had, and we've made it back to that 26,000 mark. But let's welcome on board Ruchit Jain and ask him how sustainable does it look this time. Ruchit, hi, afternoon. Time and again, we've made our tryst with that 26K mark. How convincing is it looking like this time? Or do you think again, or rather once again, we'll peter down from this mark?
Yeah, hi, very good afternoon. Well, this up move has certainly been supported by a rally in the index heavyweights, which we can see. Although the small cap space is still showing that relative underperformance, but the buying interest is clearly seems to be more in the large caps as well as the mid cap names. So, and then another thing was the recent correction which we saw towards the 25,300. We made a higher bottom around that at that low, and now even the 20-day moving average is not getting breached, which has now shifted to 25,700. So the two things. One, the support bases are shifting higher. Secondly, in this up move, there has been a good participation from the large cap names. So this gives confidence that this time we should see a sustainable move from this 26,000, 26,100 resistance, and probably we should head higher towards the 26,250 mark. So overall, the biasness still remains positive. 21,700 now becomes the support base. Until this is intact, I think market should head no further higher.
Okay, Deepak, if I can come to you with regard to the Bank Nifty. Now we've clocked record highs on the Bank Nifty. So just trying to contextualize this a bit. Give us a sense, where do valuations stack up versus earnings growth? Because H2 should likely be stronger, aided by better margins. Can this kind of a rally in the banking index sustain, is what I'm trying to get.
So valuations right now, to be honest, have become better only because all these big banks have sold Yes Bank stakes and recorded fairly large profits on their net profit basis. So therefore, their core operations haven't done that well. Didn't expect to also because of all the turmoil in exports, tariffs, changes in the there was an up move in the yields of government securities. So they saw that hit to their treasury income as well. So there is some of that will recover. The treasury income will probably do better in the last half. They will probably see some kind of lending growth as well. But they won't have all these one-timers for like Yes Bank stake sale and all that. So I expect some of the larger private sector banks to still take some time. So the banking index earnings are not going to grow at a meaningfully higher rate. So their evaluations will remain a little bit more expensive than public sector or small private sector banks, where I see both earnings growth as a big possibility. And second one is they don't have those treasury gains like Yes Bank shares and all as much as to impact their income. And they're also more aggressive on the lending front. So I would say the index wise, since it's based on more heavyweights, and we're going to see a change in the structure, right? From next month or something, there's going to be less of the largest two banks and more of the others. So hopefully that broader structure will give it more of the earnings flow from some of the smaller banks to show in. But I mean, I still think that will take some time because the way the index calculates earnings is on absolute basis. It's not weighted based on the market cap. So therefore, the earnings valuation from the index perspective will be high, but I still expect the smaller private sector banks to do better in terms of earnings growth and perhaps therefore in terms of price as well.
Thanks so much, Deepak, for coming in and speaking with us. It's been a pleasure speaking. Grows market cap is the other piece which has made news. Let's quickly pull up that stock price. Stock is flying in trade, by the way. I think it's the fourth session post listing, and we've notched 1 lakh crore in terms of market cap on Grow. The stock is up nearly 70% from its IPO price. We'll talk about this and more. Stay with us here on ET Now. We'll step into a short break. On the other side, we'll talk about that and more.
Back with closing trades right here on ET Now, holding out quite okay for the markets. The Nifty Bank now has scaled a fresh high for itself. With the trade deficit data that, I mean, I'm sure it's par for the course. The fact that you did have a hit on exports and they've gone down on a year-on-year basis. The trade secretary saying that the October trade deficit is indeed high. We will try and get in some more perspective and perhaps get a reporter to get in or throw more light on the import figures. While they have seen an uptick of about 16.5%, I'm not sure how they compare on a quarter-on-quarter basis. The exports, of course, they have fallen about almost 12%. 5% or so. But we need to see it in contrast, and we need to see it in light of what the previous times figures were. Both the trade deficit data, which of course optically is looking alarmingly high right now. It's almost a double quotient on the back of gold and silver imports, as the Trade Secretary has been quoted as saying. For the market, consumption, consumer tech, some of the auto plays, Titan, they're all the ones which are holding out. And of course, banks as well are making a stead higher. So look at a Tata Consumer, look at an Eternal, look at Eicher, Maruti, Titan, M&M, Bajaj Finance. These are names which continue to hold out. And of course, it's been Kotak Bank from within the banking pack, the large caps that is. The board is going to be mulling a stock split, and that stock has been holding up steadily from the word go. Sectorially, though, it's really capital goods all the way. That's been the sector leader today. The breadth of the market, of course, continues to look good. And now more and more of these tech plays are joining the bandwagon. Look at a Policy Bazaar that surged up about 4%. Paytm has been doing very well. There's Angel One, which is going strong, and Sammaan Capital now standing at a solid 4.5% gain for itself. Rajit, including the mid caps here, is there any sector which is looking like, the gains are going to be intact, or it's looking like it's at that breakout point?
I think auto is one space which technically looks much positive. Recently, if you look at last 2 or 3 months of data, then initially post that announcements of GST reforms, we saw a one-way up move in Nifty Auto Index of about 1.5 months. Post that, the index went into some consolidation, which seems to be more of a time-wise correction within an uptrend. And today we can see that there has been a resumption of the positive momentum within the auto space. So Nifty Auto Index seems to poised further for further higher from current levels. So I think if one is to go with the sectoral moves, then auto could be one space where we can see some good momentum in the near term.
Right. Okay, that's that right now on what are the buzzing spaces in the market. But let's try and analyze Idea Forge. I mean, the stock, of course, has been holding out a buzz. Remember, they secured that 100 crore rupee new defense contracts, which included a 75 crore rupee for the Zolt tactical UAV and a 30 crores for Switch V2 drone from the Indian Army. So let's chat a little bit about these two orders. We've got Ankit Mehta, the CEO at Idea Forge Technology, joining in on the show right now. Ankit, hi, good to have you on ET Now. Firstly, tell us a little bit more about these orders. What's the execution timeline like?
Yeah, so these orders, of course, one of the orders is for a short-term timeline, and it is also one of the orders, particularly for the one that we received for Zolt, where we have to deliver it in a year's time frame, which is standard for most capital EP cycles.
So Ankit, with this 100 crore rupee of two orders, what does it take your total order book size to?
So from the previously disclosed, at the time of earnings, it was about 240, and this additional 100 gets it to about 350, of which some of it would have been executed as well.
And hi, this is Harsha. And what is the execution timeline for the current 100 crore order that you've won? What's the sense like on that?
So, in terms of the overall order book, I think some of it will spill over to the next year because the timeline given for us to deliver is about a year from the date of receiving the order. But quite a bit of it will also get delivered within this year.
Okay. And what's the kind of demand traction that you're seeing, Ankit? Are you seeing, is it improving? What has evolved over the last 6 months, given everything that we've been through? Is there a change in the way in which it's being approached? Are Indian companies more at the forefront? What are you seeing on ground?
Absolutely. I think there is a massive change in the way the government is looking at overall the defense space, and particularly the space on drones. We are looking at ensuring that we buy as much capability locally, as well as there is a shift in terms of how it's going to get adopted, right? There is a wide spectrum that is going to get adopted in terms of technology and capability, as well as that capability. The desire is to see most of it emanating from Indian origin. In fact, if you look at what we have done in terms of technology, is that we have built all the core technologies that will now be looked at in terms of adopting drones, the GNSS denied technology, the communication resilience technology. We have built that stack from grounds up in our company itself, and that makes us stay ahead or stand ahead of other people who are system integrating this kind of technology. We are doing homegrown innovation. We are making sure that the desire and the vision that the country has, that we should have strategic hold on these capabilities, we are able to help achieve that capability, and that's going to get even more valued going forward, because when a conflict comes, we do not want to be in a place where we are dependent on other people to look at the critical capabilities that the country needs, and we need to have control on those capabilities, because we may need to evolve those capabilities at a moment's notice, because something has been changing on the field as per the adversary's response. So I think that mindset is there. The upper cap on how much the government is looking to buy in this specific sector is again something that they are saying that we are not looking at the conventional scaling approach insofar as this domain is concerned, as well as, of course, there are large budgets allocated to procure even larger quantities of this technology going forward. So I think all in all, the momentum in our sector is in the right direction. The categories that we'll be buying in is going to be very large, as well as the need for indigenous innovation continues to remain very high, because we need indigenous and Indian capability to be delivered to our armed forces.
Ankit, so tell me, what's the visibility, if you have any at this point in time, for additional army or other defense force orders?
See, in terms of the cycles, we will keep talking about as new cycles come up for procurement. But as of now, the current cycle is what is going on, which is EP6, and we are working on that cycle itself.
Are these high margin orders? This 70 and 30 crore rupee, the two orders?
I can't specifically comment on how these specific orders are, but overall, I would say that the order book is, at or better than our, expectations of around 45-50% that we usually have as an expectation.
Ankit, H1 has been low or slow on execution, I would reckon. Does that accelerate H2? What's the sense? Give us that.
Yes, it will, right? Because we received the orders only recently, so we have to accelerate towards delivery right now, and already the work is on in that direction.
Give us the 3-year roadmap. Where will you be in terms, or where do you aspire to be in terms of top line, in terms of margins, etc.?
See, aspirationally, margins, in our opinion, will continue to hold to our expected level of between 40 to 50%. In terms of where we are going to be in terms of business, I think that's a projection that we do not do at this point in time. But what I can very clearly see is that the momentum is very, very heavily in our direction, and we should see, growing procurement, you can say, initiatives from the government in this domain.
Ankit, lastly, any ongoing discussions with international defense agencies or any civil clients?
Yes, absolutely. I think the number of opportunities we are bidding in the global market as well is going up. Closures remain a little bit challenging because, again, many of our customers internationally are also governments, and the budget allocation cycles have the similar sort of limitations that we see here in India. But the number of opportunities we are participating in and we are getting as an inbound inquiry has gone up quite a bit.
Okay, here's to more orders then. Ankit, thank you so much for your time today. Okay, on that note, let's take a very quick break. That's, of course, the Idea Forge management talking about that 100 crore rupee of dual orders. Other than that, of course, how robust the pipeline is looking. That stock, of course, holding out in trade, as is the Nifty, still sticking by with the 26,000 mark. We'll take a very quick break, continue tracking markets on the other side.
Well, and joining us at this hour to take the conversation forward is Sameer Dalal. He's CEO at Natvarlal and Sons Stockbrokers. And of course, Kunal is still with us. Kunal, this move of 4% on an Anantraj, does it change the way, and of course, Ruchit's still with us. Kunal, does it change anything significantly in terms of a stock call here?
No, so in the morning also I had mentioned that I'm very bullish on the stock with a potential target of 700. So right now the stock is almost at 630, 635 kind of a range. Today, the stock tried to challenge back its 50-day moving average. So maybe another percent or half a percent higher from current levels is where the stock would confirm a breakout of the 50 DMA. But net, the pattern for Anantraj is quite strong. Very recently, I think a couple of months back, the stock was almost at 700 to 720 range, and from there we saw almost like a 15% correction. So attractive chart, and maybe a confirmation of this 50 DMA breakout could lead towards a higher target of 700 for the stock.
In fact, we did speak with the management as well of Anantraj, and here's what they had to say about the data center opportunity.
307 megawatts is what we are aiming at, and 25% of this is a conservative number, 25% of this is going to be towards cloud, and 75% is going to be towards co-location. In co-location, the company has already delivered a world-class product, which has been very well appreciated. Here, the EBITDA margins are pretty nice. They are almost about 70%. So this is, of course, we are talking about revenues right now. So the 1200, we are fully geared up. 28 megawatts is now already up. It is now in the handing over stage. And this will go to 63 by December next year, and then 117. In fact, the moment we get to 63, which is definitely by next year, December next year, we will be able to unlock the target of 1200 revenue.
Okay, so that's of course the management. Now, plenty of opportunities starting to pop up slowly, Samir, with regard to the data center opportunity, even within Indian equities. Anantraj is one. Then, of course, there's the larger TCS also foraying into data centers. Would you at all play this theme? Would you stay away for now?
Well, it's not something you can totally ignore, but would I be in a rush to get into it? No. I'll tell you why. Because you see, the initial stage is a lot of capex upfront. So when these companies talk about great operating margins, you got to also look at it that if these data centers don't get the kind of utilizations, if as much of the stacking and all doesn't happen, then the operating leverage does not play out, and the net profitability after interest and depreciation is quite large. And you got to remember that in this, the depreciation, it's not a non-cash, because a lot of these disks need constant replacement, because at the end of the day, storage, and they have a certain life with them. It's not like a 20-year, that you don't need to change these. The upkeep and the maintenance of that is quite large. Am I in a rush to play this space? No, I think this is like the back office of the AI kind of play. Is it something you should ignore? I don't think you should ignore it. Keep a track on it and see how things are going. But I'm not in a rush to make an investment in any of this. I wouldn't invest in a TCS because they're investing in the data center, or an Anantraj because they're putting in all of this capacity. I would wait for a while to see how things play out.
Right, understood. So, Samir, which are the sectors, which basis earnings you find valuation comfort and growth visibility as well?
Okay, so, the market has become so complacent over the last maybe 2 years, where we've started accepting high valuation multiples as the new norm. And then we're trying to find valuation comfort on a relative basis. So is there some amount of valuation comfort in sectors? No, there isn't. Is it in individual stock pockets? Yes, it is. So there are certain stocks in an overall sector where valuations still look relatively attractive, not relatively, but on an absolute basis attractive, where growth is going to come in. So you got to factor in both. You got to look at growth and value together. You can't look at them independently. And for me, this market is going to become a very stock-specific market going forward. Playing the broader indices may not work out. I think the indices are going to be relatively range-bound. I don't see the market on a runaway tear anytime in the near future. In fact, if anything, I see more consolidation with a slight negative grind bias. With the kind of selling that's happening from FI, the kind of paper that's coming into the market, earnings growth not as attractive as we'd like it to be. So being more selective, and for me, if I had to pick, I'd pick something in the green energy space. I think there's a lot of opportunity of growth, and some couple companies trading at decent value in the banking space. I think there is growth going to come forward. And some of the banks still trade at a decent valuation, like an Axis or an IDFC or an IndusInd. So I think you got to find individual stocks within the overall space and then make investments.
So how is it that you're playing the green energy theme?
So I think the way we can play the green energy theme is two ways. One is through the EPC players, something like a Sterling and Wilson Solar, who's been beaten badly out of shape recently because of one large order not coming through from Nigeria, and also certain one-offs that they've taken in the form of write-off because they lost one case in the US. That is one. The other is I like companies which are not doing the very, very large solar parks, right? Who are who are setting up the parks through EPC and IP and everything. But what they're doing is they're going to smaller companies and setting up the infrastructure at a single location and then selling part of those the larger scale plant to these individual companies. So something like a KPI Green Energy. That is something we think looks attractive from a longer term perspective. Valuations over the last year have corrected because if you see the stock hasn't really done anything, but the earnings have moved up quite nicely. I think you're going to see a little bit more of consolidation there before you actually see the stock moving up, because then the confidence will come through that what they're doing, the business model they're employing will start doing well. In the wind energy space, we do like Suzlon, but the problem is a lot of the positivity was captured when the stock ran up from I think 15 rupees to 75 to the high and then 50. There is upside over the next 2 years, but still I think it's going to go through another 6 months of consolidation. People are going to want to see utilizations crossing the 70% mark, and that will take some time. So these are the kind of plays in the green energy space that we think attractive. Then you got to look at companies that are doing the solar cell, because there's a big change coming where cell manufacturing is going to have to become local, and companies that are making the solar cells, someone like a Vari, will stand to benefit. Of course, there's Reliance who's got the backward integration done now, and they will start launching their entire solar panels with manufacturing the cells. But then that's too small of a play in a Reliance Industries to make. But Vari is something that one can look at, but we find valuations they're really, really expensive. So hence we're not recommending that.
Okay, Ruchit, if I can request you to give us a call with regard to Tata Motors, what should a shareholder do today? 4.5%+ lower now for a better part of the day.
Recently, the stock has seen a demerger, so not much historical data is available for demerged entity. So very difficult to take any technical call on that. But definitely from this entire auto space, we like stocks such as Mahindra and Mahindra, which is technically looking much strong. The stock is hovering around 52-week high. Consistent outperformance has been seen over there. So if one has to take any fresh call from the entire auto basket, then M&M can be bought at current levels.
Makes sense. My apologies for that. But let me come back to you, Samir. Tata Motors, what's gone wrong? And is this something which is a concern from a medium to long term for a shareholder? Is this something which is a concern?
So what's gone wrong? Well, actually, we knew before the results came out what had gone wrong was one of the cyber attack, right, that happened on them. And we knew that the production had been stalled after that, and the ramp up was also going to be slow. So I'm a little surprised to see the kind of market reaction that we've seen today, because the stock kind of had that priced in to a large extent. Now, the question that you are asking is the worst over? So if you ask me, when it comes to the numbers, maybe the earnings, Q3 will still remain a little subdued because Jaguar Land Rover makes a huge part of their profitability. And I think that is still going to be reporting a loss in Q3, given what the commentary of the management was. But then we believe that they will rebound. So I think a lot of the negatives are now priced in. Going forward, we do believe that yes, competition is intense for Jaguar Land Rover globally, which contributes to almost 65-70% of the value of the stock. But as recovery happens to these brands in their production, I think sales will also see an uptick. The markets are growing. The push that they're making in the US, in China, will continue to see traction. And I think Jaguar Land Rover will come back. Now, when you come to the India operations, right, that was the probable only, I will not say green shoot or green lining, the positive, because it also didn't report a great positivity. But things are looking better, and the market share in the domestic market is improving. On the electric vehicle front, they have new launches, the Sierra, which is coming on, but I think there'll be a lot of traction that comes there. You see their sales have continually been rising. They've been gaining market share. And I think these operating leverages will now start playing out from the domestic business. Of course, it's not anywhere near the scale of Jaguar Land Rover. But as the profitability in the domestic market starts improving and you see a turnaround in GLR maybe in Q4, the valuation multiples, if you project towards FY27, because FY26 will be a washout, if you project FY27 may not look as expensive, the cash flows will start turning positive. So I would actually take a contra call on the stock at this point and keep accumulating it over the next, say, 3 to 6 months and wait out for the next 2 years after that, where you can get really good compounded returns.
You know, the other one which is flying away in trade, and we did take Kunal's view on this one, is a Sammaan Capital. Ruchit, do you have a view there?
Yes, no, the short-term trend for the stock certainly looks positive. There has been a series of higher top, higher bottom structure off late for the stock. And the good thing is that the entire price moves have been supported by rising volumes, which usually seen during an uptrend itself. Now the prices are forming a support base around the 20-day MA, which is at 174, 175. And if this level is intact, then we can see an up move back towards 195 to 200 range. So post this recent small correction, I think the risk reward ratio again has turned favorable for a trading up move. With a stop loss below 174, short-term traders can look to create fresh longs over here.
Samir, you had built up a position on Sammaan, and of course the stock has done very, very well since that point. Believe it's up 30+% since that chat that we had. What next, and what are you seeing in terms of valuations now with the kind of rally we've seen in the stock?
Yeah, so the stock is up. Glad that it is, but that has happened more so for the investment that happened from the IHC into the company, which is something we were not, of course, aware of when we made this investment. It's a great positive that came through with the strong promoter backing now. This does multiple things. One, it allows them to get capital for growth, which was probably required. And two, because of the strong promoter and the capital infusion that they've got, their borrowing costs will go down as an overall basis, right? They get rating upgrades, and that will allow them to increase their spreads and their profitability. So positive on the long-term perspective, but the point is that given the kind of equity dilution that is happening in the short term, 40% equity dilution with 8,800 crores coming into the company, servicing that in the short term is going to be a little difficult. So ROEs are not going to be moving up in any which hurry. It will take at least 2 years for ROEs to move back up towards the 12 to 15% range where we like. So I think the stock will probably now once again become a little range bound. I am very long-term positive on this. If you have a 2-year perspective, I think the stock would probably be close to 400 rupees or 500 rupees. But I think in the near term, short term, you're going to see this range between 150 to 220 at max. I don't see it going too much because at the end of the day, we are all hoping that things start getting better with this capital infusion, but it's not going to happen overnight. And there are many things that can happen along the way. So to give him a 1.2 times or 1.3 times book value right away, I don't think is justifiable. He will trade at a one-time book, and after the capital infusion of 8,800 crores, and the stock at 190 is trading at closer to one-time price to book, which I think is a fair value for the next 6 months.
Right, okay, that's the take coming in Sammaan Capital. Big breakout today. In the last 6 months, it's moved up about almost 12% or so. Some of the other names today which are also holding out, and the auto pack, of course, is looking very smart. And Kunal, you were making that point last week, right? That finally autos once again are coming in leadership position. And that gives you conviction other than banks that if autos begin moving, perhaps we'll see a more durable and sustainable move beyond 26K this time.
Exactly. And you look at the entire day today, there has hardly been a 50-point volatility for the Nifty. Even the Bank Nifty is taking, of course, the meatier part of the gains today. But in the previous versions, in the last week or so, when the markets were moving up hard on the back of Bank Nifty alone, there was one day where the IT stocks were moving up higher, the other day IT stocks were reversing, and then came a day where you saw many of the large cap names like Reliance participating, then all of a sudden the stock went sideways. But today when you're seeing the auto stocks participating, the move is a lot more durable. We've maintained that 26,000 mark for the index throughout. Very fresh breakouts which you're seeing on the auto stocks today. So I think till last week you had Ashok Leyland, which was doing fabulously well. Today you're seeing a reversal back again to the likes of Eicher Motors. Maruti's made a good comeback, bounce back from the 50-day moving average. Hero MotoCorp at 5,700 mark is a fresh, multi-week high for the stock. So I think on the back of this, we are looking at a renewed vigor coming back from the entire auto pack, and I strongly sense that this move is sustainable, not just for the auto pack, but this could be also a strong sustainable move from a sector perspective, which is very much needed in the market, which is getting a little bit more polarized with only the banking and the PSU banking names, etc., which are performing very well.
Okay. Now, one conversation that we had today morning was around the CNG supply across Mumbai, which had taken a hit after damage to a major GAIL pipeline feeding the Mahanagar Gas's Wadala station. The disruption has forced CNG pumps across Mumbai, Thane and Navi Mumbai to be shut, affecting thousands of autos, taxis and ride-hailing fleets that rely on the fuel. We caught up with Deepak Gupta, Director Projects, GAIL, to know more about the volume loss. Listen into a slice of that.
Currently, we are expecting about 1.5 to 2 MMSCMD. That is the kind of volume which should have been supplied to this pipeline in a normal course. But then I think since this is a big pipeline, 18-inch diameter, there is some time, minimum time required to restore the connectivity. And as I mentioned, the entire team is at site now. The entire MGL team, the GAIL team, everybody with all the resources. So just give us 24 to 30 hours and we should be back supplying the gas.
Right, okay, that's the word coming in from the management of GAIL when we spoke with them earlier this morning. So pretty steady in the market right now, but let's also talk about Jubilant FoodWorks, for instance. Last week, of course, it spurred up after its same-store sales growth managed to impress the street. And right now, you're seeing that cool-off come by. So let's get a sense in terms of, what is it that we're sensing when it comes to the entire QSR piece. Samir, I don't know how closely you've been tracking the QSR earnings, but select few like a Jubilant did turn out to be impressive given the base that they're working with. Do you think this is a longer-term play?
Yeah, so I actually track the QSR space very, very closely, and I'm very positive on this space over a very long, over a period of time. What I like about the space is the operating leverage that comes through. Now, once your SSSG sees an uptick, which Jubilant has actually beaten the rest of the street, right? Everyone else has degrown, whereas Jubilant has seen an SSSG positive. It leads to great operating leverages playing out. And I believe that over the next, say, 2 years, it should have actually started in the current year, which we are delayed on, if you ask me, after the government gave the first round of tax cuts, then you had the interest rate cuts and now the GST cuts. I think the consumption push that is going to come in the domestic market is going to be exceptional. And that is going to lead to SSSG picking up in a very big way across the space. I'm not denying the fact that competition in the pizza business is quite high. You have local players coming about in the space and competing. But at the end of the day, the franchise, the brand name that Domino's has, obviously is continuing to do well. This apart, they also have other brands which they cater to internationally and domestically, which will continue to do well. So for me, growth in SSSG is going to remain strong. Store additions are going to remain strong, and operating leverages are going to play out. The issue then comes is where are valuations? Now, in this space, valuations look high, but because of the operating leverage, I think once that plays through, the valuation multiples will not look as high because when you look at it at store level, once you cross a particular threshold, every amount of additional sale minus the gross margin, I mean the gross cost. So you talk in the pizza business of Jubilant Foods, 70% goes straight to the PBT. So that I think is going to be the story for the space. We're very positive. We like Westlife developers. We like the Devyani International restaurant brands looking interesting. Jubilant is something that we've invested in and is also looking very nice. So we think this space is something that's going to do well. If I had a pick from the play at the moment when it comes to growth and valuation, is probably Westlife Foodworks. followed by Jubilant and then Devyani.
Quite interesting. Rajit, what's your take on some of these charts, the QSR plays?
I think if you look at from a sectoral perspective, then off late in this market up move, we have not seen any significant participation on any kind of relative outperformance as of now. So the short-term trend at least has not changed for now. So we would wait for some kind of reversal patterns or any kind of price volume action turning positive before taking any trading bet on these names.
Okay, a couple of minutes from close. Ruchit, Samir, we'll let you go on that note. Thanks so much for joining us this afternoon. Kunal, stand by. Ashesha is also with us. Ashesha, what are you spotting on closing?
Well, yes, first up, let's talk about Nifty. That one was gaining from strength to strength. In fact, in the second half of the day, markets did gain momentum, and Nifty is ending near that Nifty Bank is ending near that 58,990 mark. Nifty also inched nearly 110 points higher in trade today. Broader markets should also come up for you on your screens. Nifty Small and Mid Cap were also moving in tandem. Nifty Bank, of course, was the outperformer in trade today. It also touched all-time high yet again in the market. In terms of individual sectors, remember auto stocks barring Tata Motors passenger vehicle, which reported weak set of numbers. Management guidance for JLR was also negative, so this stock was declining in trade. Tata Motors PV should come up for you on your screens. That one was down nearly 4.5% in trade, the biggest loser on the Nifty 50 index. But apart from that, most other auto stocks were doing well in trade today. Maruti Suzuki up 1.3%. Hero MotoCorp, in fact, was up 4.5%. We had Bajaj Auto and Eicher Motors also bucking the trend in trade today. Metals, meanwhile, were under pressure. So Welspun Corp, Hindustan Zinc, Vedanta, all of these stocks were under pressure today from the Nifty Metal Index. PSU banking stocks were shining bright yet again in trade today. UCO Bank, Bank of Maharashtra, Punjab and Sindh Bank, Indian Overseas Bank, all of them gaining in trade today with gains anywhere between 2 to 4%. Based on news, a whole host of counters were buzzing. First up, Narayana Hrudayalaya. That one reported its numbers, and quite a reaction is what we saw on this particular counter. Up 16% by the end of today's trading session. IRB Infra on the back of that letter of award which company's associate company got. So this counter on the back of that was up 3%. Ashoka Buildcon and VIP Industries meanwhile reported weak set of numbers. So we did see some bit of pressure on both these counters. Ashoka Buildcon and VIP Industries should also come up for you on your screen. So yes, broadly, as far as broader markets are concerned, we did see stock-specific action, but on the index level turned out to be a good day. Nifty ending the day with an uptick of nearly 0.5%. Harsh, back to you.
Right. Thank you for that roundup, Ashesha. Kunal, how's the day and how's the start of the week?
Yeah, I think it's quite encouraging, and the Nifty back towards that 26,000 mark, I think is like the cherry on the cake, at the start of the week. So hopefully, I think this time around we should be able to break past about the life highs and the previous highs for the index, for the Nifty. A lot of support for the index, Bank Nifty, auto stocks, you look at select pharma names doing well, IT stocks more or less, recovery phase. So mid cap in the markets being extremely vibrant. So I think in terms of the setup, it's a classical setup. And, we just expect that this trend and this, entire setup from the overall market perspective, it just sustains for another couple of days at least.
Okay, that's the take on the auto index. I'm demiked.
Okay. Yeah. So of course that's the take coming in from Kunal with regard to how the day has been. It's been a day of strength and resilience. We hope that continues all through the week. And with that, we're completely out of time on this edition of Closing Trades. From Aisha, myself, everyone who puts this show together. Thanks so much for watching.